Module Overview. By the end of this module, you will be able to understand the purpose and structure of the cash flow statement, identify and analyze cash flows from operating, investing, and financing activities, distinguish between direct and indirect methods of cash flow reporting, evaluate the cash-generating ability of a business, interpret key cash flow ratios to assess financial health. What is the cash flow statement? The cash flow statement, CFS, shows how cash and cash equivalents move in and out of a business over a specific period. Unlike the income statement, which includes non-cash items, the cash flow statement tracks the actual liquidity of the business. Purpose: to show how a company generates and uses cash. To assess the company's ability to pay debts, reinvest, and operate effectively. To reconcile net income to net cash. Structure of the cash flow statement. There are three primary sections in the cash flow statement. A. Cash flows from operating activities reflects the cash generated or used by core business operations, such as receipts from customers, payments to suppliers, wages and salaries, interest paid or received, taxes paid. 2 reporting methods. Direct method lists all major cash receipts and payments. Indirect method starts with net income and adjusts for non-cash items and changes in working capital. Example: indirect. Net income equals 1,200,000 naira, depreciation equals 300,000 naira. Increase in receivables equals negative 100,000 naira. Net cash from operating equals 1,400,000 naira. B. Cash flows from investing activities reflects cash used in or generated from long-term assets and investments, such as purchase or sale of property, plant, and equipment, PP&E, investment in securities or subsidiaries. Proceeds from the sale of long-term assets. Example: sale of equipment equals 500,000 naira. Purchase of land equals 1,200,000 naira. Net cash from investing equals 700,000 naira C. Cash flows from financing activities reflects cash flows related to financing the business, such as issuance of shares or bonds, loan proceeds, dividend payments, repayment of debts. Example: loan received equals 2 million naira. Dividend paid equals 400,000 naira. Net cash from financing equals 1,600,000 naira. D. Net increase, decrease in cash. Net cash flow equals cash from operating plus cash from investing plus cash from financing \text net. Cash flow. Text cash from operating plus text cash from investing plus text cash from financing. Ending cash balance. Beginning balance. So net cash flow text. Ending cash balance equals text beginning balance plus text net cash flow. Cash flow statement example. ABC Digital Ltd. Cash flow statement for year ended 31st December 2024. Cash flow category amount naira. Operating activities net income 1 million depreciation, 200,000 change in working capital, 50,000. Net cash from operating 1,150,000 Nigerian naira investing activities. Purchase of equipment 800,000 Nigerian naira. Proceeds from sale of vehicle 300,000 naira net. Cash from investing 500,000 naira. Financing activities. Loan received 1 million naira. Dividends paid 200,000 naira. Net cash from financing 800,000 naira. Net increase in cash 1,450,000 naira. Beginning cash balance 550,000 naira. Ending cash balance 2 million naira. Why the cash flow statement is critical. Reveals true liquidity beyond accounting profits. Helps stakeholders assess operational efficiency. Indicates ability to pay debts, distribute dividends, and finance growth. Highlights cash burning or cash generating areas. Cash flow ratios and indicators. Operating cash flow ratio. OCF ratio equals cash from operations divided by current liabilities measures. Ability to meet short-term obligations with operational cash. Free cash flow, FCF. FCF equals operating cash flow minus capital expenditures, FCF, equals OPERATINGCASHFLOW minus CAPITALEXPENDITURES indicates how much cash is available after investing in assets. Common pitfalls to avoid: confusing net income with net cash flow, ignoring non-cash adjustments like depreciation, overlooking irregular investment or financing flows, not comparing across periods for trend analysis. Module 4. Summary. The cash flow statement is vital for understanding actual cash movement. It is divided into operating, investing, and financing sections. Indirect and direct methods are both acceptable, with indirect being more common. Cash flow ratios provide a practical lens for analyzing liquidity and efficiency. Cash, not profit, determines survival, so cash flow is king.